Right, good morning, everybody, and welcome to this week's show. I'm going to sort of quickly run through the news from the sort of world of investment companies this week. Then we're going to have Andrew McHattie in for his sort of regular monthly slot to talk about the sort of big moves in April. And then I'll be bringing on this week's special guest, which is Nick Brind of Polar Capital Financials Trust or Global Financials Trust, to talk about that. So it's quite a sort of slow week in terms of news. If you look at our website, there's quite a lot in the way of annuals, etc. But obviously, we already know what's in those, but there's some interesting things. So sort of have a look there. Of all of this, I've managed to pick out sort of three interesting things that I just wanted to have a chat with you about today. Now, the first is BBGI Infrastructure. Now, so those of you that are following this has sort of received an all-cash bid from British Columbia Investment Management Corporation, which is basically a big Canadian pension fund. And so it's all cash offer, 147.5 pence in cash. On sort of face of it, this looked like a pretty decent offer, 21% premium to the price prior to the offer, and actually similar sort of premium, 20.1% to the sort of 3-month average price prior to that. And it was a sort of 3.4% premium to the end of December NAV when it came out. I think it's a little bit lower than that. But I mean, you look at this, it kind of illustrates the madness of the discounts in the sort of infrastructure sector, which is something we've been saying for a long time. And you can sort of kind of see the effects here. This is a sort of 5-year chart, and you can see, obviously, the NAV goes up and down a bit, but broadly speaking, in the sort of scheme of things, you can see what's gone on in the last 5 years, it's been pretty steady. And you can see that sort of once upon a time, it traded a hefty premium. And obviously, that drifted out to a sort of discount as really as interest rates went up. And you can see very latterly that discount has sort of closed right up again. And if anything, the thing is trading at a small premium. You can sort of see it a lot more acutely if we just have a look at this sort of 6-month chart here. Share price has basically tracked right up towards the NAV. Now, where are we at with this? Well, as I say, when the original announcement came out, it said that if they hadn't got all the regulatory clearances in place, I think within 39 days, that they would suspend the offer until that happened. So this did actually see the offer suspended briefly, and that'll pass on 23rd of April. And once again, the offer resumed. But at that point, they said that the take up was very, very low. Basically, just 0.47% or 0.47% of the issued share capital. And they've got to get to 90% for this basically to become unconditional. Now, one of the things that surprised me about this, and if you sort of look at the news on our website, you'll see that we've commented to this effect, is that, I mean, it looks like on face value, a decent offer. It's certainly a premium to NAV, etc., small one. And, obviously big premium to what the share price had been. And shareholders have sort of been quite strongly encouraged to accept this. They're basically saying that, once it gets past the 90% level, that they're going to delist it, and that those that haven't accepted will basically still be stuck in it, and that will sort of significantly impair liquidity for those that haven't accepted. And the sort of inference is that, those that haven't accepted, they will be sort of left exposed to uncertain timing and, how this thing then sort of is unwound, et cetera, et cetera. And you kind of go, why? Because there are plenty of protections in place to, protect acquirers from being held to ransom by sort of small groups of stubborn shareholders, et cetera, and vice versa. I just didn't really feel that this was necessary. Anyway, on the sort of 30th of April, there was another announcement. Let's say the sort of deadline is on the 20th of May, and it's still 2.73%. It is really low. It's really well short of the 90% they're going to need. So I think, what is going on? On the face of it, shareholders would seem unimpressed with the offer. I think it's worth remembering that NAVs are kind of depressed by the higher interest rate environment, so people probably see some recovery potential there. The other thing you need to remember is these are fundamentally scarce assets. A lot of these sort of infrastructure assets are held privately, so they are quite scarce in listed markets. And if you sort of think about, BCI's view, they are able to take a very long-term view, and they clearly see value even at this level. And I think that is sort of probably playing a part here, that, other shareholders are going, okay, if they see value, why shouldn't we? Similarly, in an increasingly sort of certain world, the sort of defensive nature, because all of these things are availability based, but defensive nature of this sort of income generating portfolio is probably pretty attractive. And I think, these are sort of key factors. It just may be that shareholders are not prepared to let these assets go at this price. Maybe they're hoping for a higher offer, or simply, maybe they want to hang on to them if they can't get an improvement on that. But I think it's just going to be one to watch over the next 3 weeks to just see how that plays out. Next thing I just wanted to very briefly touch on is Geiger Counter. For anybody who follows this closely, it has a sort of subscription rights mechanism. So once a year, you have the opportunity as a shareholder to subscribe for shares on a sort of 1-for-5 basis at a price equal to the undiluted NAV, basically the year before, so on the 1st of May. And the sort of date that you've got to do this within is within 7 days of the 30th of April each year. So we've just passed that. In essence, shareholders would have the right to buy it at, the NAV last year. Now, the really interesting thing, you'll see this on the sort of next slide when I sort of show you what the share price and NAV have been doing. But Geiger Counter says they received applications for 102,000 shares at 74, but half peak pretty much. But the board is not proceeding, and it's going to return cash to shareholders, and this is basically why. You can see that this is sort of a 3-year chart. Actually, the share price today is way below that. And actually, the NAV has been above that couple of points in the last 3 years, but actually share price hasn't been anywhere near like that during the last 3 years. So it's kind of sort of hard to see why this has happened. But the board says that, it doesn't think that issuing shares at a significant premium to the market price, let's say last close was 34.58p versus the 74.58p, is not in shareholders' interest. So I think, Geiger Counter board is clearly looking after its shareholders. As I said, if you look at the slide that showed you, it's hard to see how that's happened. Obviously, this has been in the sights of Saba, as we know, and it feels like, some shareholders, and say, quite a few shareholders over this, it's got a very low following. Once again, bit like BBGI, these are scarce assets. And I think they may well just be solidarity or showing solidarity in the face of Saba. Now, I think the other thing to remember is that because these are scarce assets, the only other sort of significant comparator, certainly that's more pure play, is Yellowcake. And if you look at this over the longer term, Geiger Counter has outperformed that by, a sort of significant margin. And I think that is, probably why people are keen to keep it going. Next thing I wanted to talk about was Middlefield Canadian Income. We had an announcement from them this morning. This is really unusual. I think it's probably unprecedented. So basically, what they've said they want to do is offer a rollover into a new actively managed LSE listed UCITS ETF. So what would this look like? Well, you can have a sort of voluntary winding up of sort of company with a choice of either this new ETF or a cash exit close to NAV, or shareholders can elect for some combination of the two. This new ETF is going to be supported by Han ETF, which is well known in the space. Same investment objective, so high income, long-term capital growth, basically from what the manager describes as high quality, but fundamentally large cap Canadian equities that have basically got strong dividend profiles. So dividend payers. Similar sort of setup, is going to pay quarterly distributions. They're expecting expense ratios below 1%, and they think obviously you're going to benefit from improved liquidity. I think there's some sort of debate there, but it's going to be priced around NAV. So the idea it's going to do away with the discount problem. What's kind of brought this all about? Well, as we know, this sort of follows proposals by Saba Capital to push first on liquidity enhanced restructuring. This is essentially what Saba wanted to do. Middlefield Canadian say they've consulted major shareholders, including Saba. They've considered sort of other closed-end alternatives. The board has determined that this sort of ETF structure would be the best thing. It would address the persistent liquidity constraints and the discount to NAV. Going to be a little while before we sort of see all the details, but they're saying circa expected sort of by August this year. The whole thing's subject to sort of regulatory and tax approvals. Middlefield are going to pick up the setup costs for this. And one thing they're sort of really emphasizing is if you don't fancy this, shareholders are going to be able to get out at close to NAV. This is what the sort of chairman had to say. They remain confident in the long-term strategy, but they recognise the ongoing limitations imposed by liquidity and discount issues, and they think the proposed structure offers a practical and flexible solution for all shareholders. As I said, if approved, it's going to be a first for the UK-listed investment company sector. We've seen sort of rollovers into sort of open-ended funds and passive ETFs and that kind of thing before. We've not seen one into an actively managed one. They're saying it offers sort of exposure to the current strategy. As I say, investment objectives, etc., are unchanged. You know, at a sort of first glance, you would go, okay, well, you wouldn't be able to hold some things that you just can't hold in, open-ended funds, ETFs, etc. So less liquid and potentially more profitable stocks. And just bear in mind, this is an active ETF. You're not going to be able to go there. But in this case, this is large cap focused, always has been. So it's probably not an issue. One of the guys did some sort of kind of quick look portfolio this morning, and from what we can see, it's not going to hit any of the UCITS exposure limits, so that should be fine. As I say, it's going to be priced at NAV, so that's going to remove the whole sort of premium discount risk, and obviously lower charges. So could be potentially quite good. What is it going to lose though? Because obviously, there are benefits to the closed-end structure. It's certainly going to lose the sort of ability to gear through borrowing. And just looking at this, I think our net gearing at about 18%, 18th of March, quite significant gearing. Reason is it uses this to support the dividend. It's the classic carry trade. It can earn more than it's costing it to run the debt. So that's going to be a thing. But it says it's going to look to use derivatives instead. Obviously, that's going to have to be in the form of total return swap, so effectively it catches that income, and it's going to lose its independent board because that's the way these funds work. And it would lose if it was a sort of slightly different setup. It would lose the ability to hold a revenue reserve, but actually, with its sort of Canadian structure, that's not a thing. So that's actually not a case. But it's if we see more of these, it's going to be sort of things to think about. Now, I think we're sort of done with that. I think I'm going to bring in Andrew now. Andrew, you there?
Yes, indeed. Thank you very much indeed, Matt. And some really interesting news there, actually.
Yes.
That was so interesting that Middlefield is going to lose its independent board, because you just gave that terrific example of the importance of an independent board with Geiger Counter looking after its shareholders there, preventing them from losing money. So
Absolutely.
there we are. That's part of our structure. So good. I'll talk about what's happened in the market this month. And I think you're looking after the slides there, Matt. So it was a very strange month, of course, April, because it started, didn't it, on the 2nd of April with Liberation Day, the introduction of these extremely high tariffs by President Trump. Obviously, the market took fright. And this chart here shows you the reaction of the investment company sector over the month. And it's a really tremendous illustration, I think, of the old stock market adage that stock markets take the stairs up and the escalator down. Sorry, the lift down. So we had this very sharp fall followed by this steady recovery. And actually, we're largely back to where we stood at the beginning. So the net impact, actually, as it happens over the month, is not that great. And we'll see that in the movers, actually, where I think overall the movers were comparatively modest over the month. If we have a look at the list now, you'll see that 3i Group is at the top there. More excellent news from its holding in Action, and that's just been such a tremendous performer over a long period. And otherwise, I think actually a fairly muted showing overall, not too much in the way of very large movements. But there are a couple of sector themes here that I think have emerged. And there are two sectors in particular that have shown actually quite decent gains over the month. One is REITs, and you'll see a number of REITs on the list there. So this has been a sector that's obviously seen so much corporate action, and we've seen more this month with the bid for, or the proposed bid for, Urban Logistics REIT. And that sector has really been very much at the forefront of what's happening in the corporate activity. And the other sector, if you just pop on the next slide, please, Matt, the other sector that's really actually attracted quite a lot of demand is renewables infrastructure, which if you've been keenly following this show, you'll know I've been talking about for a while as being exceptionally cheap, offering exceptionally high yields. And really, we've been waiting for this demand to come through. And I think this has really been triggered by these macroeconomic events and by the Trump tariff tantrum, because actually that's encouraged people to buy these kind of shares, I think. So that's the risers, and I'll talk about a couple of those in a moment. If we have a look at the fallers over the month, again, actually comparatively muted. I feel actually the sector really did behave quite rationally and calmly over the month. We didn't get really wild swings in pricing. And there was a small part of me that was a bit disappointed in that, because I was hoping to find some interesting price anomalies and some trading opportunities. Actually, there were fewer than anticipated, I think, because pricing was quite rational. And here there were some declines, as always, of course. But again, I think there's a definite theme here, which is that a big chunk of these declines were very much as a direct result of Trump's announcement. So we've got trusts investing in Vietnam, in China, in US smaller companies, and also in shipping. Again, if we can just show that on the next slide, please, Matt. We can see actually that they account for probably half of those major falls. So the definite theme here was that in the investment company sector could not escape what was happening in the wider market. And it reacted, I think, in a very rational way. So in my mind, actually, those declines that we've seen seemed actually quite reasonable, and there wasn't very much mispricing going on. So I'll move on and talk about one or two of those special situations where we've seen rises. One was Urban Logistics REIT, and you'll probably know that this was really the first declared position from the Achilles investment company that has been set up to try to agitate in the sector. Urban Logistics REIT received a proposed bid over the course of the month. Just in the background here, we've got the year-to-date chart, so you can see there was this bump up in the share price. Now, this hasn't been confirmed yet, but I think it's probably likely to go ahead. That's just a matter of the due diligence being completed. Of course, these things are not certain, and as Matt was talking about with BBGI Infrastructure, even when the bid is actually announced, it's not necessarily going to be accepted. We should probably get some more news on this next week, because the next deadline for London Metric Property is the 9th of May. That's the put up or shut up date. So we'll probably get a confirmation there. And the deal is a share and cash mix. And you're eligible to receive the next dividend if you're an Urban Logistics REIT shareholder. So if you add all that lot up, the total comes to 155.35 pence. What interests me is that the shares are a little bit below that at the moment. They're 146.3. And so if you believe that the bid is going to be made and you believe that it will go through, then you've got a potential uplift there of 6%. And that was also interestingly true with BBGI Infrastructure, that if you believe the bid will go through and you can get 147.5 pence in cash, then actually buying now in the market at 142.2 gives you that little margin for potential profit. And I think ordinarily you might not be that interested in these really small arbitrage opportunities, but perhaps there's a reason for thinking about those now, which I'll come on to. But anyway, that's the current position with Urban Logistics REIT. And the next one I'd like to talk about is Harmony Energy, the battery storage trust, where we were waiting for the bid to come. We knew this was likely, the company was up for sale. And the first one came through from Foresight Group at 84 pence per share in cash, which seemed like a great deal, actually. And you can see in that chart in the background, there was a good uplift in the share price there. And then actually we had the joyous position of competing buyers here. So Drax then came in with an improved offer of 88 pence per share, which was recommended by the board. And actually, I must say, I thought that was it. I thought that was the conclusion. But actually, Foresight then came back again and have now offered the net asset value of 2.4, which I think is a tremendous outcome for shareholders. I don't think you can really have anticipated that you would have received actually such an excellent offer at zero discount. So a very full offer. And let's remember, this is a sector that's been hugely out of favour and trading on very, very wide discounts, which is still true of the other two remaining battery trusts. So Harmony Energy is likely to go. Well, what is interesting is that the share price is currently 96 pence, so above that 92.4 offer. So the market is suggesting that Drax might come back again. So we don't know. We'll just have to wait and see how this one plays out. And there's no timetable yet, so I'm not sure quite how long it's going to take. But I think it's a really interesting position. And I think the fact that there is obviously competing demand here speaks to a level of interest in the sector that is not reflected in those still wide discounts on the other two. They have rallied and they have come in a bit, but actually on both Gore Street Energy Storage and Gresham House Energy Storage, the discounts are still between 35 and 40%. So there's a lot of latent value there if you believe that, especially once this bid goes through, some of that capital will be repatriated into those other two. So those are the risers. And really on the subject of the fallers, I thought it would be interesting not to talk about specific trusts, but to talk about the kind of market strategy that you might think about employing now. And I've been thinking about this a lot. I've been asked about it a lot. And I think I've got three possibilities, really, for different ways you might consider reacting to this period of market turbulence. And certainly one that has arisen for sure is that there's been some switching out of risk-on positions into yield companies. And we've seen that by the sector movements, which I put into a table on the right-hand side here, where you can see the first column is the 1 month movement in the NAV, and the second column is the 1 month movement in the share price for these sectors. And you can see that China, growth capital, North American smaller companies, and technology have all derated over the month, indicating that there's selling from investors. And they've been putting the money, at least part of the money, into infrastructure and renewable infrastructure, where you've seen a re-rating from actually quite low levels. These are depressed sectors, but they are offering you the possibility of actually quite well-backed dividends, quite high dividends, some in double digits. And I think now that's a bit more attractive to investors who are uncertain about the short-term growth environment. And I've spoken to quite a few fund managers about this, actually, and they've said, well, it just makes sense at the present time. If you're uncertain about which way markets are going, at least if you're getting a dividend yield, then you know you're getting some return on your capital. And actually, that's quite comforting at this time. So we have seen investors switching much more into yield codes, and I think we might see a little bit more of that going on if the market turbulence continues. So I think that's one decent angle to take. The next angle, which relates to what I was saying earlier, really about those opportunities with BBGI and urban logistics. I think if you really are unsure about the market, then you're looking forward and you're saying, well, there's a 50-50 chance values are going to go up or down. That's not very attractive for me as a serious investor. So actually, can I skew the odds in my favor of locking in at least some small gains in my portfolio? And I think one way of doing that is by looking at these special situations where actually the opportunities for profit may not be huge, but they may be a little more certain. They're still uncertain, but they're maybe a little more certain. And perhaps you can lock in some of these small gains. And you've got no shortage of opportunities here because, of course, there are lots of trusts in the midst of windings up, corporate actions. They've got votes coming up, all sorts of possibilities actually for potential value realization. And I think it's quite interesting. I've been looking at some trusts that have been winding up actually for quite a long time, maybe a year, and I think they just gently fall out of the public domain, and people don't think about them so much. And so there's some quite interesting gaps in valuations there between share prices and the potential amounts that you might realize. So whilst there's no guarantee with that strategy, I do feel at this present time, it probably does make sense if you're quite an active investor. Now, if you're not an active investor, that leads me on to, I think, market strategy number 3, which is possibly my favorite of the 3, And that's actually to do nothing at all. And I think actually this gets a bad press because I think inevitably the media wants you to be active and to do something and to look at all the buying and selling opportunities. But of course, the whole investment trust industry is founded very much on long-term investment, on being patient with your capital, and on not overreacting to market noise. And I think it's a perfectly valid approach actually to enjoy the sunshine and ignore your portfolio somewhat. Certainly, I don't think you should overreact. And we've seen, of course, how the market has bounced back after that initial sell-off. And there may be more sell-offs to come. I mean, obviously we're in this period now where there's a 90-day pause on the tariffs, but they haven't ended, they haven't gone away. So there could be much more market turbulence to come. But I think there's no reason why, if you're a long-term investor, you shouldn't just stick to your long-term plans. And this is exactly what many fund managers do, of course. And I was talking to Joe Curtis the other day of City of London. And of course, he's a very sober, sensible, long-term investor. And he said, well, I've done a little bit of top slicing or adding to holdings, but not too much because actually fundamentally, I believe I own good companies and I don't need to change that. I think actually if very seasoned, serious managers are deciding not to be deflected from their primary strategies, there's no reason why as an investor, you shouldn't take very much the same approach. So there we are. It's up to you whether you want to buy some yield, maybe go for some of those interesting market opportunities, or just sit tight and watch the market.
Brilliant. Okay, thanks, Andrew. As always, really, really informative presentation. Before we move on, we've got a question from Tim V, which basically says, for Middlefield Canadian, will the sort of or active ETF proposals require a vote, and what will be the threshold? Now, I am pretty sure that they will require a vote. I don't think that they can convert this without doing that. Obviously, this has got a kind of Canadian structure, so what the threshold is, I've not looked up, but I believe it's going to be about 75%, but would need to check that and come back to you. Anyway, thank you, Andrew, and thank you, Tim.